This video will discuss working capital as a percent of gross revenue. In an earlier video, we defined working capital, so you know working capital is a dollar amount, and it is equal to current assets minus current liabilities. In this video, we will discuss working capital as a percentage of gross revenue. Remember, gross revenue comes from the income statement, and it's simply a reporting of how much sales of products the farm produced, or and how much products are on hand at the end of the year. So gross revenue is cash sales plus those inventory amounts that are like crops in storage or market livestock that are actually on the farm. So working capital to gross revenue simply determines how much of the gross revenue. Now this is before expenses, but how much of the gross revenue during the year is still available at the end of the year in order to pay current liabilities. The definition of working capital to gross revenue is simply equal to working capital to gross revenue is simply equal to working capital divided by total revenue. Okay? So let's put that into the Excel spreadsheet and see how it would look. Right here, I'm going to go equals, and I'm going to open a parentheses, and I'm going to go click on current assets. Then I'm going to subtract current liabilities, close parentheses. Now that is working capital, just like defined in a previous video. And then I'm going to divide that by, then we'll go back to the income statement and click on total revenue. Okay? So what does that number 0.32 tell me? Well, that number is 0.32 is 32%. That says to me that 32% of the farm revenue generated on the farm during the fiscal year is available at the end of the year to pay for current liabilities. Now, what could cause that number to be higher or lower? Well, if you had a really good year on the farm and had a lot of revenue and not too excessive of business expenses, you would simply have a very high level of net farm income from operations or profit. And if you did that, then a lot of that net farm income from operations should be available at the end of the year to pay current liabilities. Of course, the flip side of that would be if you had a kind of a bad year, in other words, farm prices were low, and once you generated your gross revenue, your expenses were a large portion of that gross revenue, then you wouldn't have very much left over at the end of the year for the to calculate working capital. So that number, that 0.32, simply tells us what percent of that gross revenue was still available on the farm at the end of the year to pay for current liabilities.